Hi, I'm Tom Lydon, editor of ETF Trends here in Hollywood, Florida at the Inside ETF Conference. I'm here with Steve Sachs, head of capital markets for Goldman Sachs Asset Management. Steve, great seeing you.
Tom, always good to see you.
Exciting time for Goldman Sachs, new entree into the ETF marketplace, really kind of in the smart beta world, but specifically multi-factor smart beta. So for advisors that are interested in smart beta, what's the difference with multi-factor smart beta?
Yeah, no, it's a great question, and it's really something we've spent a lot of time talking to the advisor community about. So the core issue here is not just smart beta and how do I allocate it to it. That's really the back half of the problem. The front half of the problem is, what is factor investing? The things that they've looked at to date, a lot of single factor ETFs, smart beta ETFs out there. How do I build a portfolio with those? From our approach, from the active beta approach, it's actually a multi-factor approach. It's 4 factors, time-tested factors, and we combine them in a very thoughtful manner. We use an equal risk-weighted approach, so essentially it allows you to allocate to a core multi-factor based portfolio to help solve that problem of how do I use this in my clients' portfolio.
Let's walk through it. So what are the 4 factors?
4 factors are value, quality, low volatility, and momentum.
Okay.
And those are factors that have obviously been around for many, many years. Lots of academic research. We have used them in our investment process at Goldman Sachs. And in fact, the active beta strategies themselves that existed for a number of years inside Goldman Sachs have a significant amount of assets benchmarked to them from the institutional community perspective. Really, it's the approach that we take in putting that portfolio together. As I mentioned, it's taking those 4 factors, building individual factor portfolios, and then equally risk weighting them, we think actually gives the portfolio a much better risk return profile in a combined portfolio.
So as an example, you have an emerging market ETF using these strategies. We talked earlier, the idea is by utilizing a tilt towards these factors, you hopefully might be able to have a little bit of alpha with less volatility. Is that the goal?
That's exactly right. So we like to refer to it as these strategies are very benchmark aware. The active beta strategies start with a cap weighted universe. Yeah. We apply the active beta strategy to it, which essentially results in about a 2% active risk versus that original cap weighted benchmark. So essentially what you get, a series of small tilts based on the factor scoring that again gives you, as you say, the opportunity to outperform with a lower risk profile.
So you're still pretty much correlating very highly to the MSCI Emerging Market Index, but with hopefully a little bit more risk, less risk, less volatility, maybe some alpha over time, and that's what the idea is all about.
That really is, and it really helps from a trading and liquidity perspective when you've got that high correlation to those passive benchmarks out there.
And that ETF already has 600 million in assets in a short period. Obviously there's something about it that institutions and advisors like. Continued success, Steve. Great seeing you.
Good to see you. Thank you, Tom.
Thank you.